A very warm good afternoon to all the participants who have joined in today. I'd like to welcome you to the third day of the SIRC Metro Conference. In fact, physically, the Metro Conference, as rightly highlighted by our chairman at the start of it, was usually meant for the city where the conference is not held. Normally, the home headquarters of SIRC, which is Chennai. But now, since we are in the virtual mode, all the conferences are almost pan-India, not only restricted to city, a state, or even the region. It goes pan-India. In fact, we have many international people also who join our conferences. So I like to say this Metro conference is continuing that trend. Of course, unlike the first day, we are missing our chairman of SIRC who conceptualized this due to some other commitment that he has. He's meeting the president at Vizag. So because of that, he's not able to join today. But we have with us an exceptional speaker and a past chairman of SIRC, Shri CA Phalguna Kumar sir, who is joining us live from Tirupati, in fact, and he is going to take us through on a very interesting topic. In fact, many of you may have had questions, because even I had the question. I was talking to him just offline before the program went live. So he said there are two topics in this: taxation of trusts, which we are all very clear, we can understand them, and exceptional transactions in income tax. So naturally the question was, what is exceptional transactions? Even I was thinking what it is, and sir clarified. It's a very interesting topic, and let me tell you, my dear friends, when you hear what this exceptional transaction is, you will appreciate this more than anything else that we have had. Many taxation sessions, even budget sessions we have had, and this exceptional transactions, sir is going to take us through many practical examples of where there's a thin line between what is taxable and what is not taxable, and where the drafting by a professional like a chartered accountant will make a difference there on what is the final outcome of the cases. So with many practical examples, equipped with his several years of experience, I must say, he is here with us today, and he is a very busy person, so his time is very valuable. Thank you, Phalgun sir. Now I'll just formally introduce you, even though I am sure you're a person who needs no introduction, having held the sort of positions that you have held at our institute. I'll still have to formally introduce you. So I'm going to take the pleasure and privilege of introducing our past chairman of SIRC, Dr. C.A. Phalguna Kumar sir. He's aged about 65 years and is a practicing chartered accountant at Tirupati since 1979 and has more than 42 years of experience. He is also married to another person who holds a doctorate, and his spouse was principal of a college, and he also, his daughter and son, both of them are equally dynamic chartered accountants as well. In fact, his daughter-in-law is also a CA. He is a person who believes in continuous education. He holds MA, MCom, MBA, BL, DISA, and PhD as well. He's also a company secretary, qualified company secretary. He was a member of the Regional Direct Taxes Advisory Committee and was appointed as a member of Board of Studies of SV University and SP Mahila University for the period 2012 to 14. He has presented more than 370 technical papers in many CPE seminars across India and CA branches, and has given lectures on GST in over 50 lectures across South India. He is the serving trustee and executive member of several charitable institutions at Tirupati, and has been appointed as a finance committee member for 3 years of IIT of Allahabad in UP. He was a member of the SIRC for 9 years from 2010 to 2019 and held the position as chairman SIRC for the year 2016-17. He's a very down-to-earth person, a very friendly and jovial person. When you get to know him personally, it's always a joy to spend time with CA Phalguna Kumar sir, and he's a true leader. So thank you so much, Phalguna Kumar sir, for accepting our invitation to be here. This topic is a very relevant topic, especially given certain changes that have come in the budget. So we have an apt speaker to talk about this. So thank you so much, Phalguna sir, for joining us today. We're looking forward to your session.
Very good. Shall I start? Esteemed Chairman of SIRC, who is at Vijayawada today to receive the ICAI President from Delhi, and Secretary Dr. C.A. Abhishek Murali, and other committee members, and my valued professional colleagues. As Dr. Abhishek has said as a prologue, today the 3-hour session is having two topics. The first topic is private trust. Normally, as part of CA syllabus, there is a chapter for public trust, section 11, 12, 13. Normally, every CA, some way or other, is connected with some non-profit organizations. So, about this public trust, we got a lot of exposure. And there is a dedicated chapter in the Income Tax Act granting exemption, not only under section 1023C, but also under section 11, the exemption subject to section 12AA registration till March, coming March, and after April 1st, we are going to have 12AB registration. So the new changes, you are all aware. But what about the private trust? So the private trust as a separate chapter, nowhere else is there in the Income Tax Act. So from various sections, we have to cull out the applicable portion and then try to understand what is a private trust and how it is being taxed. So I have chosen today in the first half to deal with this private trust creation, management, taxation, and finally winding up of the private trust also. The second session has more interestingly adding some flavor Abhishek has already put. It is really interesting for me also to deal with such topic. As he rightly said, under the Income Tax Act, several computation of income provisions. There is a thin difference in interpreting the words, in roping in some receipt as income. Sometimes it is a receipt but not an income. So what are such transactions which will become taxable on one side, and the same transaction from the other angle if you see? I have been dealing with decided cases, not an imaginary something hypothetical situation already interpreted by the judiciary. Based on those judicial decisions, I will throw some light on those exceptional transactions as I coined the name. Thereby, one can understand the tax implication. So in the day-to-day practice, how much care we have to take to fall within that non-taxable bracket. So including 4 days back budget which has plugged in the partners receiving from the partnership firm, that also I will try to deal. It was because of some exceptional transactions which were not being taxed hitherto, the government has brought the amendment. So like that, I would like to throw the light. So now coming to the first topic, private trust. What is the difference between a public trust and a private trust, first of all? If the beneficiaries are identified, a trust, first of all, Indian Trust Act 1882, section 3 says, a trust is an obligation annexed to some property arising out of the confidence reposed by the owner of the property in another person who is known as the trustee for the benefit of another person. So the trust is an obligation annexed to the property. So in only 3 states public trust acts are there. In Tamil Nadu also a bill has been in the recent months passed by the assembly also. Tamil Nadu Public Trust Bill 2020. It has not yet come for implementation. So in southern India, no other state is having a public trust act. So any trust, even if it is a public trust, is governed by the principles of Indian Trust Act 1882, which clearly says that the Trust Act is applicable for private trusts only. So still now, even now, because the Indian Constitution the trustees and trusts are in the concurrent list. So as they are in the concurrent list, so long as the state is not promulgating a specific act, the central act will prevail. So we are trying to understand what is a trust, and especially a private trust. A trust is an obligation annexed to the property. That means a owner of a property may be movable, may be immovable. The owner of the property should express his intention to divest the possession as owner. Thereby the trustee is going to get the possession. The trustee is holding the same for the benefit of somebody else. So the three persons here are necessary, whether it is a public trust or a private trust. So the author of the trust, otherwise known as the settlor of the trust, the trustee who manages the trust, and then the beneficiary. So the income, the property of the trust, the income of the trust, for whose benefit is being managed and who should get the derived benefit. They are the beneficiaries. So based on these beneficiaries, we have to differentiate a trust, whether it is a public trust or a private trust. Because many a number of times, this differentiation will get confused. For example, under the Income Tax Act, Schedule 4, Provident Fund Trust, a recognized Provident Fund Trust is being created for the benefit of employees by the employer as per the provisions of the Income Tax Act. Thereby, the trust income is exempt under Section 1025. The beneficiaries, the employees, what they derive as their portion of Provident Fund contribution, their contribution, employees' contribution, employers' contribution, together with interest, when they get back in their hands also is exempt under Section 1012. So trust income is exempt. The employees, beneficiaries' income is exempt. But is it a public trust? No. It is a private trust. A Provident Fund Trust, a gratuity trust, a superannuation trust, or any other labor welfare trust created is a private trust because the beneficiaries are identified. If the beneficiaries are identified persons, it is a private trust. So a private trust is prohibited from applying for registration under Section 12A, the present operative section, maybe from April 1st, 12AB. Only public religious or public charitable trust should apply to the Commission of Income Tax for exemption. A private trust cannot claim exemption. So these private trusts, I can give some more examples also. For example, every limited company issuing debentures, as per the Companies Act, has to constitute a debenture trustee. So the trustees, on behalf of the debenture holders, they protect the interests of the debenture holders, the mortgage property, the security that is given, the distribution of income, that is the debenture interest by the company to the debenture holders. So similarly, there can be a creditor's trust. So the private trust can be, even if you think of the word business trust, in 2014, the present government, when it has come to power, it has brought in the business trust. Even the 2021 February 1st, just 5 days back, the budget has touched something about the exemption, the pass-through status for business trust is given. So the private trust or for identified persons benefit. If they are there, they are the private trust. So today we will try to concentrate more on the private persons or the beneficiaries. That means an author of the trust is creating a trust for the benefit of some individuals. Let us assume. So there is no necessity that only for individuals a private trust should be there, especially in the Western world. Rich people will have rich pet dogs, pet animals, maybe bird, maybe a animal. So in their name also they write the trust deed. It is also a private trust. If for many animals welfare, if you create a trust, unidentified animals in India, Goshala, for the cows protection, it's a public trust. For your pet dog, if you write a deed, and after my demise, this particular property, this particular bank FD shall go to the benefit of that pet dog, pet animal, then it is a private trust. So the beneficiaries, if they are private persons, individuals, then it is a identified individuals, it is a private trust, otherwise it is a public trust. So then how to create it? Two possibilities. The author of the trust, who is the owner of the property, who is the settlor, he can now itself divest his ownership, possession. If it is immovable property, registration of the trust deed is must as per the Indian trust. If it is not an immovable property, if it is only a movable property, even unregistered document is sufficient, but possession shall be divested. Possession shall go from the owner's hands to the trustee's hands. So the creation of the document, even a oral trust is recognized by the Income Tax Act. But oral trust is not advisable because oral trust always taxable at a maximum marginal rate. Whereas the instrument, deed, if it is evidencing the trust, then it is better that direct MMR will not be there. So I advise to create a trust deed. What is the deed or the word instrument? The instrument or deed, actually, the proper stamp duty, if you are applying, it is a deed. If you are not applying the proper stamp duty, it is an instrument. So witnesses should be there. So the properly executed document, whether an instrument or a deed, as I said, if the property being transferred to the trustee is immovable property, means registration. Otherwise, even without registration, the trust will come into existence. What are the conditions to be satisfied to create the trust? The property should be specific property. The trustees are identified persons. The purpose of the trust shall be mentioned therein, and who are the beneficiaries also shall be specifically mentioned. So if these three conditions are there, then it is a valid trust deed. Now in this trust deed, three different possibilities are also there. What are the three different possibilities? A, the beneficiaries may be existing now or may not be existing now, future persons. That means a baby in the womb or a grandson going to be beget by the son and daughter-in-law. So if they are going to get the children, then they will be the beneficiaries. So here the rule of perpetuity is there in the Transfer of Property Act. So the TP Act will decide the validity of, because for existing property, Section 5 will apply for the transfer of property. Otherwise, for a unknown person also you can transfer the property, but there should be a continuity rule of perpetuity. That means the non-existing persons a presently existing person should proceed through him. So then it's all right. So for unborn children or a daughter-in-law going to get married to his son, so grandchildren. So like that, this one possibility, a trust to private trust can be written. Second, with a definite share in the property or the income, property and or the income, or without any share, specific share, you can write it. So this itself makes, from the taxation point of view, definite trust and indeterminate trust, or otherwise known as the discriminative trust. So a definite trust and a discriminative trust. Definite trust is otherwise called as a specific trust also. So if the particular property income will go to particular person, then it is a specific. Or out of the total property of the trust, a particular defined share will go to a particular person, that's also a specific trust. So if there is a specific trust, one possibility, discretionary trust, second possibility. So from taxation point of view only, we have to deal more the difference between specific trust and discretionary trust. So the third possibility, is the trust revocable or irrevocable? So section 60 to 63 deal with revocable trust. If it is merely income is transferred without transferring the property, the transferor is liable by clubbing provision. Though the income you may apply to the particular specific person, but the transferor is liable if only income is transferred but not the property. Even if the property is transferred, it's not going to be coming back to the hands of the transferor, then it is a irrevocable trust, irrevocable transfer. If it is a revocable transfer, that means at any time the transferor is having a right to get back the property, then it is a revocable transfer. Revocable transfers also, the transferor is liable for the income. That's the law, 60 to 60. But there is an exception for this. During the lifetime of the beneficiary, it is not revocable. During the lifetime of the beneficiary, not the transferor, not the author who is paying, then it is deemed to be irrevocable. So he should not derive any personal benefit out of it. He transferred it for the lifetime benefit of the beneficiary. Only after the lifetime of the beneficiary, it may come back to the transferor. Then also it is a irrevocable trust. So irrevocable trust only we should try to understand, because from the taxation point of view, clubbing of income is not going to be any beneficial. So you are seeing in 64, the minor child's income shall be clubbed with one of the parents' income whose income is highest, or the property transferred without consideration to the spouse or daughter-in-law, the transfer of hands, it is going to be clubbed. So that's how the clubbing provisions we should keep in mind. Now coming to the creation of the trust, subject to section 5 of the Indian Trust Act, section 6 says the trust will come into existence if these conditions are satisfied and the deed is specific. Now we will try to understand a little bit more about the specific trust. The specific trust is, as on the date of drafting the instrument, the person should be identified. Number one. Number two, the share in the income or the property whose income is going to that particular person shall also be specified. If these two things are certain, then it is a specific trust. If these two things are not there, then it is a discretionary trust. So a trust can come immediately into existence if the settlor wishes and creates the deed, or the settlor, the author of the trust, can create the trust, whether it is a public trust or a private trust, through will. After his death only, the trust shall come into existence, he may say. So if it is through a will, then it has got some advantage, because in the trust taxation, will is given a higher importance and concession. So that we are going to see. So the trust creation, then comes the trust management. The trustees, as per section 15 of the Indian Trust Act, shall deal with the property as if it is his own property. It doesn't mean that he can enjoy. He must. The word trustee itself is emanating from the word trust, that he should not 1% have any self-interest benefit, directly or indirectly. This applies to public trust also, as we have seen in section 13 of the Income Tax Act in the case of public trust, to avail the benefit of exemption. Here, though it is taxable, personally the trustee shall not derive any benefit directly or indirectly. In fact, section 50 of the Indian Trust Act says, a trustee per se shall not draw any remuneration. He accepted the position of the trustee means he should do the voluntary service for the benefit of the beneficiaries. For example, I write a trust deed that I am appointing my wife after my death. I am writing a will. After my death, I am appointing my missus as a trustee, and the property shall go to my grandchildren when they attain the age of majority. Though my grandchildren are now existing, they are minors. I don't want the property immediately to go to the minors' hands. I want to protect the interests of the minors. So I appoint my missus as trustee first, and then after her death, say I appoint my son as the successive trustee. Then till the age of majority, all the minors get the age of majority. That means the last minor also should become major. Then the property will go to minors. Till that time, the income shall be accumulated. If I say, can my missus, after my death, for her day-to-day living, can she draw any money from this income of the trust? No, because I have not authorized, I have not given any discretion. So the beneficiaries being minors, they cannot give by contract, you please have something. No. So the law is such that the trustees must, without expecting any remuneration, shall do their service for the benefit of beneficiaries. So the trustees shall not buy the property of the trust, shall not sell the property of the trust unless they are authorized. For example, in the case of a creditor trust, the author of the trust may say, an individual, he may say, I have 1 crore debts. After my death, I am appointing so and so as the trustee. My properties, this trustee shall sell and then settle the creditors. So then trustee is authorized to sell the property and then clear off the creditors. And if anything is remaining, you please give to my son or pass on it to my grandchildren. So a creditor's trust I can create because I am having debts. So there it is permitted to sell the property. Otherwise, private trust trustees shall not normally have the power to sell the properties. They have to only manage, because there is no power given to them by the author of the trust. So like that, the care has to be taken to protect the interest. Why all these duties are casted in the Indian Trust Act? The beneficiaries can sue the trustee. Please understand. The beneficiaries can sue the trustee for not taking proper care to protect their interest. Their property is not properly protected. The trustee, in fact, has to maintain the books of accounts, proper accounts. The beneficiary is given a right to inspect the books of accounts. The trustee is having an obligation under 1617 to maintain the books of accounts, and the beneficiary is given a right to verify the books of accounts and then have a copy of the books of accounts also. The beneficiary is having a right to inspect the books of accounts and then take a copy of the books of accounts also is given. So these are all the duties of the trustee and the rights of the beneficiary. When the purpose is over, when a particular time bound say time limits are given in the trust deed, and at that time the beneficiaries have got a right to ask the trustee to transfer the ownership. Automatically the trustee has to transfer the ownership and title to the beneficiaries. So the trust may be for a definite period, the trust may be for a indefinite period, a perpetual. One trustee after the other trustee will try to manage. In that way also you can write the trust deed. So the trustees are having an obligation to maintain the property and the books of accounts and then to discharge their duty. That is, the income may be distributed. The expenditure of the beneficiaries maybe is the obligation of the trustees to meet. So then the trustees have to properly meet such expenditure. So these are all the things. So so long as the trustees are discharging their duties properly, as envisaged in the law, beneficiaries cannot go and force the trustees to share or to divest the ownership and transfer the property. So this is the Trust Act. So the trustees have to properly manage. Then the question comes, why at all these private trusts? Since 1872, the law has come. Why they are there so long and why it is there? It is but natural. Parents sometimes they feel that their children maybe only one child is spastic child. Then who is first, who is second, the parents, who is going to live long, they don't know. Then they have to create a trust, and then after the death, the reliable trustee shall take care of that spastic child. Maybe for some other reason, if they are not having that much confidence in their children that they will manage the property properly, then they may say, instead of you children, we are transferring all the property for the benefit of the grandchildren, but you act as trustees only. Or along with others, maybe a professional chartered accountant is also appointed along with the children as trustee. Thereby law is complied. And then ultimately, especially the big families, business families, instead of directly giving the freedom for the children to deal with the shares, they create a family trust. The family trust is nothing but a holding company. A holding company will hold the shares of all the other companies. So the holding company is the investor in the other companies which are all doing the business, whereas the holding company is the family managed company, but it's nothing but a trust-like thing on certain mutual terms and conditions it will get. So the trust law is one way a better law in the sense, instead of a limited company, instead of a partnership firm, all the properties after my death shall go to the partnership firm in which all my children are the partners. It's not going to be that beneficial when you compare with the trust. Trust is the better mode than a limited company, than transferring the properties to a limited company, giving shares, a particular percentage of shares to each child, or creating a partnership firm. The trust is the better mode because so many future uncertainties can be taken care of in the trust. Then, is there a definition in the Income Tax Act for trust? The word trust is not defined in the Income Tax Act. So we have seen the trust means as per the Indian Trust Act. Similarly, the word individual, though the person is defined in section 231, that person definitions, though 7 categories of persons are there. Trust is not a person as per the Income Tax Act. So, how a trust shall be assessed? So, the trust shall be assessed as per the Supreme Court decision. The trust shall be assessed in the case of CET versus Sodra Devi, 32 ITR 615. So the 32 ITR 615, in the case of Sodra Devi, the Supreme Court held that a trust shall be assessed as an individual only. So the status of the trust is individual. Very rarely, in exceptional circumstances only, a trust may become an AOP, but 99% all the private trusts are in the status of individual only. They should be assessed. This is the Supreme Court decision is there. This is also supported by even the Madras High Court decision in 221 ITR 649, the Revenu Suresh Sanjay Trust. 221 ITR 649, even the Madras High Court has upheld the same. So the trust shall be assessed as individual. Then what it means? All the benefits that the individual is going to have, the trust also can enjoy, like slab rates, basic exemption, 54, 54F benefits. So all these things are available. So definitely it's a better mode of having a good succession planning through a trust. So the private trust is a better mode. Trust can be created. Instead of revocable, make it irrevocable. And then the trustee is accessible in the capacity as a representative assessee as per section 160. So the 160 representative assessee is there. Actually, the preceding section 159 is the legal representative. If normally a person dies, the legal representative is liable to discharge the tax liability, including filing the return on behalf of the deceased, is there in section 159. So now coming to the 160, unlike the word legal representative, here is a representative assessee. A trustee is a representative assessee, but he is not the agent. He is a representative assessee. So what is the representative assessee's trustee's duty? He must maintain the records. He must file the return of income on behalf of the beneficiary, because a trustee is liable as per section 161 in the like manner and to the same extent as the beneficiary is liable. So the trustee's liability is to file the return of income of the trust on behalf of the beneficiary. For example, a private trust is there for the benefit of 2 persons. So the trustee, if it is a specific trust, for such each individual, if the total trust income, say 60-40 is the ratio for the 2 individuals. So the trustee shall file one single return actually on behalf of the 2 persons. So the assessment, though it is 1, the tax computation, the tax liability will be bifurcated after computing the income in respect of each beneficiary separately. So in respect of each beneficiary, instead of filing a separate return, for the total trust income, one return is filed, but every time the income shall be assessed as if for the 60% income beneficiary A, what is liable in the hands of A is being discharged by the trustee. The remaining 40% is the income of the B. On behalf of the B, the trustee is filing the return. So in the same assessment, the liability of B, as if what will be the liability of B is being determined, and that slab rate, that tax is being assessed, income is assessed and tax liability is fixed in one. Actually, there is a section 166 which gives the taxing authority to opt to assess either in the hands of the trustee or in the hands of a beneficiary. That means directly the assessing officer can assess the income in the hands of the beneficiary. So in case the assessing officer chooses to assess the trustee beneficiaries, he cannot again assess the same income in the hands of the trustee. Only one income, one time. So normally such situation will arise when the trust is a specific trust and every year the income is being distributed by the trustee to the beneficiaries. So the income is distributed to the beneficiaries as per the terms of the trust deed. In that case, the assessing officer can assess the income in the hands of the beneficiary and then recover the tax. An assessing officer can ask the trustee to withhold the tax liability. So the trustees have to pay the tax, the beneficiaries have to pay the tax. That much portion of tax, the assessing officer can ask the trustee to withhold without disbursing during the previous year. So then the trustee will discharge the tax liability of the beneficiaries and the officer can ask the beneficiaries. But this exercise, once it is exercised, year to year it cannot be changed. The assessing officer has to continue to go by that option only. What I try to drive home, the assessing officer, once he chooses that he wants to assess the trustees, then 1 year trustee, 2nd year beneficiary, 3rd year trustees is not possible. He must continue to assess the trustees only if he chooses trustees, or if he chooses to assess the beneficiaries, he must assess the beneficiaries only. And the Act has casted the primary duty on the trustee, but the option is as the representative under 160. But under 166, discretion is given. So the second dichotomy generally will be if 2 or more trustees are there, still is it individual or AOP? The trust property is there, beneficiaries are more. Beneficiaries are though more than 2, the shares are definite, then individuals only. So in fact, the residential status, it is not the trustee's residential status that is necessary to be taken to levy the tax. They apply the tax provisions. Beneficiaries' residential status is more important. If the beneficiaries are resident, the income shall be assessed in the status of residents only. If the beneficiary is non-resident, then in the status of non-resident only income tax provisions have to be applied, though the resident trustee is a resident. So it is the residential status of the beneficiaries that will determine the computation of income, just like individual under 5 heads of income with all exemptions, tax savings. So only the liability is discharged by the trustee as a representative assessor. So the 167B in the case of AOP assessing is that provision applicable if more than 2 trustees are there. The CBTD circular itself is there, 577, circular number 577 dated 4990. No question of assessing as AOP. CBTD circular number 577 dated 4990 is there, which says there is no application of AOP in the case of trustees, though there are more than 2 trustees. Once the trustee is assessed in the hands of those beneficiaries, because the beneficiaries may derive some portion of income through tax. On their own, they may also earn some income. Then in their return of income, is there any possibility of taking this portion of this trust income, which is already assessed in the hands of the trustees, even for rate purpose? No. There is the Madras High Court in 2003, in 262 ATR 593. It has stated the PN Bajaj case. So the Madras High Court should have said, even for rate purpose, you should not take what the income already assessed in the hands of the trustee on behalf of the representative assessee as the representatives on behalf of the beneficiary shall not be taken into account even for rate purpose, though it is the income that is being transferred, shared by the trust. So the private trust, which is for the benefit of identified persons, is managed by the trustees. They will maintain the accounts, and if trustees, beneficiaries ask, they have to show them the accounts. They must allow the beneficiaries to take copies of the same. And then if the period comes to an end, that means the author of the trust, original settlor may say, at a particular point of time, the trust shall come to an end. So the trustee shall divest them of their ownership and then transfer the ownership to the beneficiaries for whose benefit the trustees manage. Then the trustees, by chance, paid taxes due on behalf of the beneficiaries. They have been given a right to recover. This is there in section 162 of the Income Tax Act. That section 162 says, in case the trustees discharge the liability of the beneficiaries, they got a right to recover it from the beneficiaries. So this the tax liability is mentioned in 161, and then its recovery is also. Then section 160 to 163 for specific trusts, tax liability is envisaged. 164 specifically for discretionary trust, how it is to be taxed. So as we all know, normal individual rates, slab rates is one part, which we have already touched, that if it is a specific trust, that means the beneficiaries are identified. There may be a single beneficiary, there may be more beneficiaries. The property with relation to a particular person is identified, it is a specific trust. Or total trust income, only a percentage of share, particular share is shall go to a particular person is identified, then also it is a specific. Always specific trust to be assessed with slab rates unless a business is transferred. So even for a specific trust, if the business is transferred by the author of the trust, then such business income shall be subjected to tax at a maximum marginal rate. So only the business income shall be subjected to tax at maximum marginal rate. The other income, either coming from the trust, the other income other than the business income, again it is subject to normal rates only. Only the business income is taxable at MMR, even in the case of specific trust. For this, the exception is there. What is the exception? In case such business income is coming to that particular beneficiary on account of the trust which is coming into existence through a will. So through a will, if the specific trust is coming into existence, even such business income shall be assessed with the other income at normal rates only. So the business income per se is taxed at MMR in the case of specific trust, but if such business is coming to the hands of the trustee through the will of the testator, then the business income in the case of specific trust also shall be assessed at normal rates only. Then we'll go to the second part, discretionary trust, section 164. Discretionary trust, what is meant by discretionary trust? The beneficiaries are identified people only, maybe, but how much income shall go to each beneficiary is not identified. It is the discretion. It is the trustee's will or the conditions envisaged in the trust deed are such that one cannot identify how much portion of income shall go to which person. So in total, for all the beneficiaries' benefit, if the trustees are managing, because the share in the income is not specifically identified with the identified person. When it should be there, actually at the time of writing the deed, original deed itself should be there, not after some time. But anyhow, there are certain nations which say, in case of non-existing persons, for the interlocutory period, in the sense the interim period, in the sense till the person comes into existence, it is discretionary trust. When once the person comes into existence, it becomes it loses the character of discriminative trust. It becomes a definite trust, specific trust. So that is the decision. Anyhow, controversial decisions are there. But anyhow, even the discretionary trust per se normally MMR. But even for the discretionary trust, MMR will not apply if some conditions are set. What are the conditions? That discretionary trust is coming to existence through a will for the benefit of a relative who is depending on for support and maintenance on the author of the trust, then it is the only trust. If these 6 conditions are there, then by satisfying the 6 conditions cumulatively, even the discretionary trust is accessible at normal rates only. So the discretionary trust, where the shares are not definite, but if it is satisfying through a will for a dependent who is depending for the support and maintenance, then it is only will, only trust through that will. Then automatically normal rates will apply. So this is how even a discretionary trust is enjoying the status of individual and lower rates. It is better if someone plans like that, so that the private person's interest is being protected in such a way that by creation of this trust, the immature people or the people who are not having the capacity to deal with the things, even through the trust deed, the author of the trust can appoint professionals as trustees who come forward. If the author of trust wants to give some remuneration, he may fix the remuneration. He may say, I'm appointing 2 chartered accountants to manage this. Those 2 chartered accountants of the gross income as their fees, they can take 10% of their total trust income as their fees, and they have to manage professionally. And then the 90% of the income shall go for the benefit of the beneficiaries. So the advantage of the trust law can be taken to protect the interests of the beneficiaries through the trust mode. Then the trust, if it is executed before 1/3/1970, then also it is though it is a discretionary trust, for the benefit of relatives if it is there. These are all the exceptions provided in 164. 164 for discretionary trust, actually it didn't use the word discretionary trust. For a trust where definite shares are not there, these are the, at the tax shall be levied at MMR with the following 4 exceptions. So the 4 exceptions what they have given is that if the trust, the beneficiaries are not deriving any other income which is more than the basic slab rate, that is more than 2.5 lakhs, if they have no other income, the beneficiaries, all the beneficiaries are not deriving any income more than their basic tax limit, then also MMR will not apply, though it is a discretionary trust. Similarly, if the trust is created before 1/3/70 for the benefit of the relatives, then also for such discretionary trust, no question of MMR, or the slab rates only. And as I said, if the income is coming out of a will and it is the only trust that is created by the author of trust, then also MMR will not apply. Similarly, for labor welfare trust, as I said, so the labor welfare trust, actually there is a CBTD, a circular also, there is a circular number 320 dated 11/1/1982. So there also the CBTD has said that even in the case of welfare trusts and public societies, public welfare societies, so the normal slab rates only shall be applied, no question of applying the MMR, maximum margin rate. So the trustees manage the property and then discharge their obligation towards the tax by filing the return, maintaining the accounts properly, and then in case the assessing officer chooses to assess the trustees, they have to file the return. In case the assessing officer chooses the beneficiaries to be taxed, the duty of the trustees is to furnish the details and then try to discharge the liability fixed on the beneficiary to be discharged by the trustees. So these are all the minimum things to cope up. And then once the assessing officer chooses the beneficiaries to be assessed, then trustees have no obligation to file the return of income. So this is also a decided case law, though as a representative assessee primarily apparently responsible, but because the assessing officer has chosen the beneficiaries to be assessed directly, then in that case trustees have no obligation to file the return of income. This is there in the case of A. Razak versus CIT 48 ITR 276 Calcutta and also 226 ITR 357 Madhya Pradesh High Court decisions, saying that the trustees are no longer liable once the author of the trust, assessing officer chooses to assess the income directly in the hands of the beneficiaries. So then minors trust. So most of the cases, what is the minors trust? If the beneficiaries are minors, then it is a minors trust. If during the minority, the income has to be accumulated. During the minority, the income has to be accumulated. That means the Income Tax Act provisions must be read together, whether Section 4, Section 5, scope of total income, Section 6, residence. So even for the trust assessment also, Section 5 is more important in the sense the income accrued or arisen, the income received or deemed to be received is the primary basis on which tax has to be, total income has to be computed as per the 5 heads and then tax has to be levied. So now if a trust has come into existence in such a way that it is for the benefit of minors, but the minors are not given the income because they have no discretion to use the money, the trustees are tasted with an obligation to manage the trust in such a way that the income shall get accumulated after a particular event, maybe the minors becoming major or the minors becoming majors and getting married, and after they getting married also, if they beget children, then after that only. So if the conditions are imposed in such a way that the handing over of the accumulated income is postponed, then in that case, when the income is taxable. So the question arises, the income to be taxed in the case of accumulation trust. So in the accumulation trust, in the case of accumulation trust, the income is not taxable in the year of raising. Actually, why? Why? Because the logic is the beneficiary's income is to be assessed in the hands of the trustee in the like manner and to the same extent. The beneficiaries are minors, let us assume. The beneficiaries are minors and their income is getting accumulated, they have no right to receive. So when they have no right to receive, accrue means a right to receive. Actually, they are not receiving. So there is no right to receive, nor they are not received it. In fact, no question of deemed receipt. So when the minors are not having the income as per the provisions of the Income Tax Act, that is right to receive or actually they are not received, it is getting accumulated in the hands of the trust, then trustee's responsibility to pay income tax will not arise. So this is the in nutshell, what I want to say, the words in the like manner and to the same extent used in 161, how to interpret, especially in these cases. So the Supreme Court in 108 ATR 555, in the case of a Nizam Family Trust, in the case of Nizam Family Trust, that is the landmark judgment. So how to interpret the word in the like manner and to the same extent has come in that 108 ATR 555, the Supreme Court has said. Based on that, the two decisions were applying the same principle. Accumulation trust income is not taxable in the year of accumulation. So this is the principle. This is supported by CIT versus Muthukrishnan, the 2003 260 ITR 526, the decision, and 2010 latest edition of the Madras High Court 321 ITR 305, the latest Madras High Court edition 321 ITR 305 in the case of CIT versus P. Sekhar Trust. So here, if it is an accumulation trust, no question of taxing during accumulation. Only when the accumulation comes to an end, then the income shall be taxed. So the accumulation trust is one more area where we as practitioners must spare some time and then try to understand how to comply the law. Why we say it's a possibility. It's a possibility that the income cannot be shared because they are not capable of dealing with the income and the property. So the author of the trust created the terms and conditions, laid down the terms and conditions in such a way that when they are capable of contracting, in fact, the trustees must have the capacity to contract. So a normal person having the capacity to contract only can be a trustee. So these trustees, for the benefit of beneficiaries, will manage the trust property and then hand over the trust property. Actually, 2-3 other permutations, combinations if you want to examine. Can a beneficiary renounce, transfer, or revoke his interest in the trust? Yes, it is possible. The beneficiary, if he is having the capacity to contract, can say, I don't want the trust property, I am revoking in favor of the trust. I am revoking in favor of another beneficiary. He can transfer. If all the beneficiaries revoke, for example, a father created the trust in favor of his 4 children. The trustees are managing. Then the trustees are managing with a hope that one day or other the trust property will go to all the beneficiaries. But during the time itself, all the beneficiaries said, we don't want all the property. Each one individually is revoking or say renouncing his interest in the trust. Then if all the beneficiaries renounce, then the property will automatically go to the author of the trust. So the trustees have nothing to do. They are only managing. The property will not. But during the managing time, in whose name the investment should be there? In whose name the 54 exemption or 54F exemption, because the money has to be dealt. The trustees in their name, they have to deal with the property and the income. Still, the exemption in the hands of the beneficiary will be there. Because the trustee, in case it is a specific trust, for a beneficiary 1, I am depositing this money. For beneficiary 2, I am depositing this money. So the name may be the trustee's name, but when he is acting on behalf of the beneficiaries, so the benefits will go in tax computation in the name of those beneficiaries, because the word in the like manner and to the same extent has to be interpreted like that. Number of decisions are. So the property at the end shall be given back to the beneficiaries is there in section 56, the right to transfer of possession of the beneficiaries. Similarly, right to inspect the books of accounts and then take the copies, it is there in section 57 of the Indian Trust Act. So these sections are there in the Indian Trust Act. So the trustees have to discharge their duty as per the Indian Trust Act, and in case beneficiaries have become majors, beneficiaries have got the capacity to contract, the beneficiaries can pass a resolution allowing the trustee to draw salary. For your services, we are now authorizing you to draw the salary. Though it is not there in the original trustee, though the Indian Trust Act section 50 prohibits any remuneration to be drawn by the trustees. But when they get the beneficiaries get the capacity to pass a resolution, give a consent, then if they put everything in writing, then the trustees can draw the remuneration. So that's how the provisions have to be interpreted. So then, in case a specific trust, beneficiaries are minors, and the trustees every year managing and transferring the money to the beneficiaries' benefit, then in whose hands the income shall be claimed. So if the minors are getting the income during the minority, they are receiving, it is shared by the trustees, then it is the income to be assessed in the hands of the minors, because the Income Tax Act has not made the minor as a liable person. In the parent's hands, clubbing provision will apply. So it is not in the trustees' hands, so in the parents' hands it will get claimed if it is an income to be assessed. So the private trust is not as a tax planning tool, but as a benefit to protect the interests of the individuals who are not having the capacity to deal with the property or the income. This private trust will come as a handy tool. So carefully, by drafting the trust deed and then taking the provisions, all the provisions and the decision case law. So here also, as I said, the Income Tax Act has not specifically carved out how to comply the law. It's only by summing up all the other provisions, decided case laws, we have to comply the law. So it's a beneficial status. So one has to utilize the provisions of the Income Tax Act to pass the benefits to those particular individuals who normally are not capable of managing the property on their own. In that way, the private trust, whether it is a definite trust or a discretionary trust, can be managed, and tax planning can be done. Multiple trusts also can be created, but the multiple trust is not favorable in the sense if more than one trust is there, and if a person is going to derive from 2-3 trusts, then his income will be taxed at MMR. Now, in the normal circumstances, I have explained you, if there is a business income for a specific trust, also MMR, except one exception. Similarly, a discretionary trust per se is MMR, maximum marginal rate, but exception. I have told you that if it is through a will for a relative dependent, then all normal rate. So a discretionary trust normal rate applicability is always better. The specific trust also normal rate provisions applicability is always better. And then all the other benefits given by the Income Tax Act for individual shall also be utilized in the case of these things also. Then the tax liability is not a big burden, and definitely it's going to be a handy tool. So we'll have a 10 minutes break, and then we will take one or two couple of the questions. If the organizers are there, one or two questions we'll take, and then we'll go to the next topic after the break, that is exceptional transactions under the Income Tax Act. So any questions? Organizers are there? Hello? Abhishek?
Sir,
So,
Helva here. Tell me, sir. Abhishek,
yeah,
sir.
then we will take questions at the end also. Can we give you a break now?
Yes, sir. We can take a break now, sir, and we'll take the questions at the end. Yes,
At the end, we'll go to the more interesting topic, that is the exceptional transactions under the income tax. Now we'll take a break, please.
sure. I'll just put a message to everyone, sir, and you can rejoin. Just
Okay.
keep it as such, and you can mute yourself, and we'll just start after 5 minutes or 10 minutes. Thank you. Sir, can we start now, sir?
I will go. No problem.
Yes, please. Thank you, sir.
Okay.
Yes, sir, you can start now, sir.
Friends, the second topic, as I have already explained to you, is that some of the transactions, though the money is received by the person, the benefit is there to the person, it will not be treated as the income. They are the transactions. So, because they are the capital receipts in most of the cases. As we know, the basic principle of the Income Tax Act is the income definition 224 is an inclusive definition. The capital asset is an exclusive definition. The capital gains chapter specifically transfer of capital assets, deemed transfer of capital assets are liable for taxation to the extent specified only. Whereas for revenue transactions, normally the income is taxable. Even the old BC Srinivasan S 125 or 294 even now holds good, saying that if the computation mechanism fails, the income is not taxable. There should be a specific charging section, specific computation mechanism, then alone the income is taxable. Irrespective of the nomenclature given in your accounts nomenclature is not the criteria to tax the income. This is there in Kedarnath Jute Manufacturing Company Limited. There is 82 ITR 363 even now holds good. So what I want to say, sometimes the employer may give salary. In the recipient's hands, it's not taxable. Sometimes a money is received from a businessman. It's not taxable in the hands of the receiver. Sometimes a money is received, a one-time payment by another person. That one-time payment, even after 56(2)(10, earlier individuals HUFs 56(2)(7, without consideration or for inadequate consideration, if they receive some money, it is other source income. Now from 1819, the 56(2)(10, any person receiving from any other person without consideration or for inadequate consideration, the money received, though it is a capital nature, like gifts are capital nature, one-time affair. Even then, gifts are roped into 56(2)(10 with the exception that gifts from relatives is not taxable, not to be taken as other source income. Otherwise, say gives the other source income. Similarly, purchase of property for a lesser value. So the seller is liable if he is a transferor of a capital asset under 50C. If it is an immovable property, 43CA for a business transferor, whereas 56(2)(10, any person receiving the immovable property for less than, with a 50,000 rupees mark, less than the guideline value given is other source. It's a capital receipt. So now after 56(2)(10 brought into the statute also, still is there any possibility some of the capital receipts are not taxable, or some of the revenue items are not taxable? What are such situations? For example, a person receives interest. Normally the payer says, I am paying you this much towards principal, this much towards interest. Is that interest taxable under that other sources? there are circumstances that interest is not taxable, though it is subjected to TDS, though the giver has given it as interest in the hands of the recipient. There are certain situations that interest is not taxable. So these are all the transactions. Let us examine one by one where the thin difference is there between the taxable and between the non-taxable, and what are the decisions. These are not mere hypothetical, just like say with imagination to take it based on the decisions we have to examine now. So I will try to take you through different situations where these items are to be dealt. For example, first we start with salary. Salary, the word, the charging section 15, salary is taxable. Salary means defined in section 17. 17.1 salary includes perquisites and profits in lieu of salary. Profits in lieu of salary includes any compensation paid by present employer, past employer, even after ceasing the employment, termination of employment, at the time of termination, after the termination, from the previous employer, if he receives any compensation, that is also taxable as salary. Even the advance salary is taxable, maybe 891 relief. So salary is roped in with all the words, in cash, in kind, present employer, previous employer. So now an employee died, and after his death, a pay revision commission revises for the services of earlier period before his death, along with other employees. Some arrears are calculated, and to the legal heir of or legal representative of the deceased employee, some money is paid. Is it taxable as salary arrears? Till the date of the service, till the date of his death, what is the service he has put in? He is entitled to some arrears. So the employer pays those arrears to the legal representative of the deceased. Is it taxable? The courts held what is accrued, what is right to receive till the date of death only is the income of the deceased. Though it is received after the death, the right to receive should be there till the date of the death. Till the date of the death, there is no pay revision commission, there is no question of income accruing or calculating. Only after the death of the employee, the pay revision commission has ascertained the money that is due to the employee and then paid to the legal heir, legal representative of the deceased. So in that case, it is a capital receipt, not taxable. Another situation, an employee in a factory died, or an employee even working in an office died. All his employee colleagues, an employees association, they have pulled up some money. They have paid to the wife of the deceased that pulled up money. Now 56(2)(10) will it apply? Saying they are not relatives of the recipient, the widow. Widow never seen them, only first time they have come and given it. So they are not relatives. From third party, received the money without consideration. What is consideration? 56(2)(10). Have they defined in the Income Tax Act? Consideration is not. Then without consideration, why they give the money? Because the employees got some benefit. The benefit was given to the colleagues by the deceased employee because they shared his experience, knowledge, maybe guidance. to pay as a tribute, to pay as a gratuity, they have pulled up some money and they have come and given it. Because the spirit of 56.210, when we see that in the name of gifts, the black money shall not become white money. That's what the spirit of the section. Here, nothing. The employees, his colleagues, they have come and they said, please keep this money because it is a loss. You lost something. That loss we cannot 100% indemnify, fulfill. So we are making something contribution, at least partially, to make good the loss. That loss itself is the consideration. We cannot say the Contract Act section 2D consideration means to abstain from doing. Somebody's loss also is a consideration. So we cannot say easily that merely they are not relatives and the non-relatives give some lump sum amount, so it is taxable under there. We cannot say based on 2-3 decisions. So I am trying to take you through these decisions. So the first edition is executors of the estate of late D.S. Mistry versus second ITO 31 TTJ 241, the Bombay. So it is the employer paid rather than an obligation, something extra. So the employer paid something more than his obligation. I'm giving you the citation once again, 31 TTJ 241. So the Bombay Tribunal 1988 decision. So it said what gratuitously the employer has paid more than his obligation is not taxable. Another decision, an employee was terminated, let us. So he went to the court. It took a long time, a battle. Then the court, as a mediation, asked some money to be paid. Then the lump sum amount paid by the employer to the employee as a compromise amount. Is it salary? Maybe from earlier employer only. The profits in lieu of salary or on termination of services, it is a compensation. That is 17.3, section 73 will not apply. Or the department cannot say the workman's compensation 1010B as per the Industrial Disputes Act, something only is exempted, beyond that you received it from employer. No. The court held that because of the court litigation, the employer has come forward to settle the dispute and then paid the money, then it is not taxable. This decision is Arunbhai R. Naik versus ITO 379 ITR 511 Gujarat High Court. So even from that employer, what he received is not taxable because it is not an obligation. So to resolve the dispute, what he received is not taxable. Another third decision, this number 16 TTJ 401 Madras Tribunal. So in the case of V. Vaidiswaran versus ITO. So there they said an employee received from his employer due to accident, the employee lost some limbs. So as per the Compensation Act, what they have to pay, Industrial Disputes Act, the compensation was paid. Over and above that also, the employer paid some lump sum amount. So whatever he paid, because he lost his limbs, because of that his living itself is very difficult. So not only what the Act has specified, something more the employer has paid. So it is a capital receipt, not taxable. The Madras Tribunal 16 TTJ 40. Even now 56.210 can it be applied or not? The other source under the head salary, can we say that the salary includes all compensations paid by the employer? Compensation to the extent payable, it's all right, but gratuitously if the employer pays something, it is a capital receipt. Definitely, we can argue that though these decisions are all before the 56(2)10 coming into statute, though they are there, but still the word consideration used in 56(2)10 will go to say some loss is suffered. To compensate the loss, only the other money is coming from the present employer also. So it is not taxable. So this is how I try to say, though on the face of it, the amount may become part of the salary, but we should not simply take it as salary and then offer it to tax, because the situation is in such a way that only last compensating amount is there. So this is not taxable. Then I'm going to second situation, that is the advances. Second situation, what I'm taking. Normally, if a person receives some advance, two possibilities: for sale of a capital asset. Second possibility, for sale of a inventory current asset. If sale of a capital asset, some money is received, 56(2)9, whatever he forfeited the advance, earlier used to go to reduce the cost of the asset, whereas now forfeited amount is other source income. 56(2)9, the few years back brought in section. For a capital asset, advance money, sale advance money received and forfeited. Secondly, for current assets, advance money, anything forfeited. There was a confusion earlier, but with the amendment from 1419, section 28(2), the fifth clause 28(2), that any payment received for termination of any contract relating to business from 1419 is taxable. Earlier also, for example, in CIT versus Sundaram Iyengar and Sons 222 ITR 344, the Supreme Court said it is taxable. It's a business receipt. You gained. So it's a business income. So specifically, more specifically, from 1419, the business head charging section 20 is amended. This tax advances forfeited, capital assets advances, other source income. Business assets advances forfeited is business head income. Now I am giving the other side when it is not taxable. When it is not taxable, the other side. For example, a person agreed to purchase a flat. He gave some advance. Now after some time, due to some bad construction, let us say, from the builder, he received more than what he paid and he terminated his. In drafting the agreement, if you say that I, the purchaser, has got a right for your 402 apartment, now I am transferring it in the name of Mr. X. Now you please sell to X. Then the rights sold is a capital right, sold is taxable as capital gains, short term or long term. Instead of that, I am surrendering to you because you are paying me this much money. I don't want to have litigation with you. You are interested not to continue the sale agreement, and I am not interested to enforce my right of purchase. So whatever you pay, I am receiving and satisfying. So then he is surrendering his right of purchase. What he receives more is not taxable. It is a capital receipt, but not taxable, because no capital asset is being transferred. A right is also a capital asset, but it is not right transferred to somebody. Sold. If you transfer to somebody, it is a sale taxable. But you given it to the original right giving person itself, then it is not taxable. For example, for this, I will give citations. The Delhi High Court decision of 2016, 384 ITR 161. Girish Bansal versus Union of India, 384 ITR 161 Delhi. Another decision, the 2018 Bombay High Court decision 400 ITR 108 CET versus the Parley Soft Drinks Bangalore Private Limited. So this is a Bombay High Court decision. So here the purchaser went to court. In the court, ultimately a compromise money is received in Girish Bansal judgment. So what you received extra, is it taxable? So the purchaser's extra money out of dispute, to avoid the dispute, he settled and he received back his advance with some extra money. Whatever he received extra is not taxable in these two decisions. So there is a thin difference between advances being forfeited or taken back, when it is taxable, when it is not taxable. So if you rely on these decisions, if the situation is there similar to it is not taxable, and then normally on the face of it, whether a capital advance forfeited is taxable under 56(2)(9) and a current asset advance, it becomes taxable under 28(2) with from 1419 with a specific amendment. Earlier also it was there, but now specifically it is amended. Now I am going to the third situation, compensations. Normally the word compensation means compensation not necessarily to the word. Accident insurance claim also is a compensation. So any accident insurance claim, for example, personal accident insurance, a individual takes, and he files a case against the lorry fellow who has hit his scooter, thereby he suffered some injury, maybe temporary, maybe permanent. Even in case of death in the accident, his legal heir will file the suit against the person who caused the accident. They receive a lump sum. So whatever they receive, lump sum amount is not taxable. It is a capital number of decisions. Even now, the loss of the person, loss of the limbs, or say loss of the person itself is a good consideration. Even under 56(2)(10, from unrelated party, you received the money, insurance company received the money, nothing doing, it's a not taxable. Then we will go to the bigger compensations, that is immovable property. If it is acquired by the government, the 1894 Land Acquisition Act, or which is replaced by the Revocable Act 2013, that is a right to fair compensation and say rehabilitation and act, rehabilitation act, a very big lengthy name. So the 2013 Act. Under section 1037, agricultural land being a capital asset, if it is compulsorily acquired, its income is totally exempt under section 1037. 1037 what specifically says under the Income Tax Act for compensation when it is not taxable? If it is an agricultural land within the urban agglomeration, being a capital asset, compulsorily acquired, okay, we are exempted. But there is section 96 in this Revocable Act 2013, which says that notwithstanding anything contained in Income Tax Act, any money received as award under this act, any money received as compensation under this act is not taxable. So this 2013 Act, which has come into effect from 2014, is containing a section which specifically said any compensation. What that any compensation? Not necessarily agricultural land. In the outskirts, you are having house plots. The government wants to lay a national highway or a railway line or a electricity high voltage line, transmission line. So, in Schedule 4 of the Electoral Act, there are around 13 acts: Railways Act, Electricity Act, National Highways Act, like that, several 13 acts. So, under those 13 acts, if specifically acquisition is made, compensation is paid, award is given, then to the extent mentioned in the act, such award not liable for income tax, because it is there in the particular act, section 96, not in the income tax act. So in 2016, the CBTD realized the mistake and then gave a CBTD circular number 36 of 2016, saying that yes, we are also recognizing that other than agricultural land also, any land building, any compensation given under that Compensation Act is not taxable, CBTD circular. So because of that CBTD circular, some assessees who filed the capital gains paid the returns also, then within that time they filed the revised returns and then try to get back what they paid as capital gains tax. So the transaction, the compensation, is it coming? There may be several acts, but the Electoral Act 2013, the Right to Fair Compensation Act of the, which replaced the old Land Acquisition Act 1894. If it is covered by this act, there, why we are saying specifically is it covered by the act? There may be some acquisition. The computation of the award compensation mechanism would have been borrowed under this new act. Thereby the property owner will not go to court, because the new act is giving a more higher compensation. So then you will not go. Only computation mechanism, if you borrow, this exemption will not go. The award should be as per this act. What is this act? This act covers acquisition under several acts, so which are all to be notified by the government. So under those notified acts, if the acquisition is there and then the compensation is given, then though it is a capital receipt, it is not taxable. So this is the sum and substance. So actually, as I said, the accident compensations are not taxable. For example, the decision Urvi Chirag said for Site 179 TTJ, Ahmedabad Tribunal, 31 dated, this is a 2016 edition, 179 TTJ 245. 179 TTJ 245. An accident insurance claim received by the individual is not taxable. Number of decisions say. Similarly, this CBTD circular has said it's a for other properties other than agricultural lands also, yes, it need not be taxable. For example, a partnership firm has taken an insurance policy for its partners. One of the partners met with an accident. So for partial disablement some amount, for total disablement also it received. Two types of disablements to the partner, and he received the compensation from insurance company. The policy is taken by the firm. So the decision, even for partial disablement, for a total disablement calculated amount is a capital receipt. For partial disablement amount, is it taxable? Is it taxable? So the partial disablement amount also is not taxable, is the decision 32 ITD 254 Chandigarh bench. So Vinod Kumar Gupta's ITO, they said even for partial disablement, what they received in the sense, partial disablement means, say the money for losing his income, he would have received some money. Is it taxable? That's the question. So though he regained his capacity to work normally, the insurance money what they gave, because there is a part of total disablement and there is a part of partial disablement, the money is not taxable. So the compensation principal amount we have dealt with. The compensations normally, if they are covered by this new act, not taxable, though there is no specific provision because of CBTD circular. Now we'll go to the interest portion of this compensation. What is this interest portion? Whenever compensation is paid, there is an accident insurance money or a land acquisition insurance. The time between the happening of the event and the final payment as award, the compensation amount, there will be a big time gap normally. The 1894 Land Acquisition Act or this Reflar Act 2013, what is provided, for example, this new Reflar Act, section 72 and section 80, two sections are there, similar to section 23 in the 1894 Act. What they say, if the compensation is paid within 1 year from the date of taking possession, if the compensation is paid within 1 year from the date of possession, 9% rate of interest. If it is not paid within 1 year, from the end of that 1 year till the date of actual payment of the compensation, interest shall be calculated at the rate of 15%. Your bank FD is not giving the original 9% or 15%. Still, as on this date, also these interest rates are. So mostly the government entities, government itself, the district collector himself, have to pay this 15% interest. Now, is the interest taxable? Is the question. There were earlier lot of difficulties. Interest is given for 6 years, 8 years, 10 years. So then the department itself cannot reopen more than 6 years. So the person who is receiving the interest is opting for accrued system of accounting, then not to levy the interest of the tax portion on this interest, tax portion on this interest. So ultimately the income tax department, to avoid this many years going back, reopening all this is a waste. So they amended section 145B, saying that 145B1, interest received after finalizing the award is taxable in the year of receipt only, on receipt basis, not on accrual basis. So the accrual basis set aside. 145B1, interest after finalizing the award is taxable on the receipt basis. Okay. Then 57(4) gives a deduction. Any interest taxable received on account of compensation, 50% deduction shall be given. That means the remaining 50% only is the other source income. So you are having 194 LA also, a TDS section. So the interest payment on compensation shall be subject to TDS provisions. Now with all these provisions, interest is on cash basis income 145B, 50% deductible, 50% interest only, because for so many years interest in 1 year itself it is taxable, means very hard. So 50% interest is given deduction. There is a circular also about this, TBD circular dated 14/10/2011. So in spite of all these things, courts held very beautifully, the courts held majority of the times interest is also part of the principal compensation only. The interest, though is by namesake interest, interest is not interest as income, interest is part of compensation. Why? Because the interest definition in 228, for the money that is parted, what you get back as extra by whatever name you call is interest. Here, the land is parted by the landowner. He is not aware how much is going to be the, though primarily the land acquisition officer, government officer will fix some money. It's not a proper fixation. You go in first appeal, district court, second appeal, you will go to high court. So when you go up to Supreme Court, after 15 years, you are going to know what is the correct amount of compensation. So when you know the correct amount of compensation, only interest is calculated on the compensation. So till the compensation amount is fixed, you don't know the interest portion. So the envisaged, the income tax envisaged interest is, once the compensation is fixed, from the date of fixing the compensation till the date of payment is interest is interest. Fixing itself has taken a long time. After fixing the final compensation, whatever is calculated from the date of fixing the final compensation is the interest, real interest, which is taxable. Till the fixation of the final compensation, whatever the interest, because the interest has to be given from which date? From the date the possession is taken, either under the old Acquisition Act or under the new Acquisition Act. The interest has to be calculated from the date of possession. But interest has to be calculated on what? On the compensation. Compensation is fixed after 4 years, 5 years, 10 years. So after fixing the compensation amount, on that amount from the date of possession, the interest is paid. So interest is not interest. Interest is also part of compensation. Number of decisions. So once the interest is part of compensation, compensation is exempt because it is a compulsory acquisition. So interest is part of compensation. 147 ITR, 169, sorry, 417 ITR, 417 ITR, 169. This is the decision dated 8/8/2019, Rupesh Rashmikant Shah. So 2019 decision. So once the interest is part of compensation, non-taxable, where is the question of TDS provisions? TDS shall not be deducted. TDS shall not be deducted even under 194 LA. See Nanda Kumar versus Union of India, 396 ITR 21, 396 ITR. Even TDS shall not be deducted. If the collector, while paying the compensation, this much is the interest, I am going to deduct TDS. No, please stop, no deduction of TDS. This is the AP High Court decision 2017 that even under that 194 LA, TDS shall not be deducted. Because it is not interest, it's a part of compensation as per the court's decision. Even the Supreme Court decision is there, 315 ITR 1, CET versus Ghanshyam HGF 2009 decision. But actually in 2020 August also, Rajpal Singh versus CET, Rajpal Singh versus CET, 2020 August, the Supreme Court decision, 108 CCH 701 Supreme Court decisions. So here also it held that interest is part of compensation. So once interest is part of compensation, because of all these decisions, there is a Bangalore Tribunal decision of 2019 is also there. So because of all these 4 decisions, interest is, though named as interest, is part of compensation only, hence it is not taxable. The enhanced compensation, in the enhanced compensation, the interest is part of compensation, because when you go to court for enhancement of compensation only you will go. So first compensation you will receive under protest, then you go for appeal. So sometimes without receiving also you will go in appeal. So you refuse to receive, or if you receive under protest, you got the right to go in appeal. Then the enhanced compensation interest is part of the original compensation only, not taxable. The Bangalore Tribunal decision, that is a Bangalore Tribunal ITA number 1387, Bangalore 2019. So this decision also, Lakshmama versus says enhanced compensation also, interest on enhanced compensation is also part of compensation, not liable for income tax. So majority of the decisions have proved that the interest, though named as interest, is not liable for taxation. Then I will move to some other topics because the time available is short. I have got many instances, many exceptional transactions like this. So I will try to explain the other things. The banker's one-time settlement. So for example, COVID, a loan has become a NPA. So they waive some amount as in one-time settlement. The overdue amount may be relating to principal, may be relating to interest. Now, what is taxable, what is not taxable? Normally, if a businessman avails the loan, this interest to the extent he claimed but not paid. He claimed as business expenditure but not paid. So when he is not paid 43B itself, he would have disallowed. Then where is the question of when it is waived again second time offering? No, already I have not claimed the interest. I have not paid the interest. So it does not come as expenditure. Any expenditure once you claim and reduction in that liability 41(1) will come. We will deal with it a little bit later. But anyhow, we are now trying to say that in case for acquisition of fixed assets, a term loan is there. So term loan principal amount is waived. Don't worry about the interest. If the principal amount is waived, it is a capital receipt, not taxable. It's not a capital receipt, it's a capital liability reduction. So this is there in 404 ITR1, CIT versus Mahindra and Mahindra Limited, 404 ITR1, the Supreme Court decision. So it is binding on all the in all the states. It's a valid because it's the apex court decision. So Bombay High Court also in 2020, the latest edition is there in the case of PCIT versus Principal CIT versus CCOM SI COM CCOM Limited. The Bombay High Court decision is there in the tax publishers direct tax 690. So there is one more decision of this CIT versus Compact Electrical Limited 66 DTR 38 Karnataka. So there is one a Delhi High Court decision similar to this. The Delhi High Court decision says a person borrowed unsecured loans. After some time, he said, I am not going to pay. My capacity is not there. The principal amount of these unsecured loans at par with the term loans availed from the banks, which are now written off one-time settlement. So the principal amount of these even unsecured loans waived by the creditors, by the unsecured loan lenders, is not taxable. CET versus Paspati Spinning Weaving Mills Limited, 378 or 80 Delhi High Court of 2015 decision. So the capital liability waived is not. Actually, we may think of the from 2018-19 assessment area, you are being following the ICDS. Any liability, if it's a government subsidy received also, shall reduce the cost of the asset. The AS 12 government grant, and then the ICDS 7. So we may think of the subsidies, government grants like that. Here the money is not received, liability is written off by the giver, written back by the borrower. So the capital liability reduction is not taxable. The effect of these decisions, even now under 56(2)(10), any money received during the previous year, money is not received during the previous year. Some 4 years back, 5 years back, 10 years back, money is received. So it's not any sum of money received during the previous 56(2)(10), attraction will not be there. Liability got reduced, capital liability got reduced, maybe from the bankers, maybe from the unsecured loans which have been carrying on 5-6 years back. So it is not taxable. This is the fifth area I have dealt with. Now sixth area, compensation for loss of income. As we have seen, profits in lieu of salary employer-employee, it's also a compensation, taxable. Section 28, business head. Any person receiving compensation, for example, a business entity having 4 agencies for distribution. One agency is being cancelled. So to forego that one agency, they received some compensation. It's taxable as business income. So specifically 28(2) is there. 20. But compensation for loss of source of income. Compensation for loss of source of. Compensation for loss of income is taxable. Compensation for loss of source of income is taxable, is highly debatable. Highly debatable. In the sense, in the Butterfly Marketing Private Limited 2019 decision 179 ITD 431 Chennai Tribunal, they said compensation for loss of source of income is not taxable. The SSC has taken a leased land and it was enjoying, and that lease right they have surrendered to the original owner. Their lease right of 99 years is surrendered to the original owner. Towards that they received the compensation. Towards that they received the compensation for surrendering their 99 years lease right. So here no question of transfer of any capital asset. Surrendering of a right, because it is a loss of source of income. They received 4.65 crores. It is not taxable under this section 45. So the relying on 80 ITR 147 Supreme Court decision, the Chennai Tribunal in 179 ITD 431 said it is a loss of source of income, it is a capital receipt and not taxable, they have said. Maybe in a later side, if a woman gives consent for divorce, loss of source of income, so she receives some amount, let us say, it is a general saying, after the marriage, first 6 months, wife only speaks, husband listens. Second 6 months, husband only speaks, wife listens. And after 1 year, both of them speak so loudly, neighbors only will listen. So after some time, they have to take divorce. Both of them have gone to court. Now the court grants some alimony. So for giving divorce, the husband, you are the earner, he is not earning any money. You are so rich, please pay some money. Now she comes to you as a chartered accountant to take the advice that the court has given 2 options. Either you want some monthly money, he is ready to give monthly to your lifetime, or you want a lump sum amount. Which one you prefer? So you as a tax consultant have to give the advice. The law is, if she opts for monthly money, it is yearly taxable income. If she opts for lump sum amount, it is a capital receipt, not taxable. It was so held in Princess Maheshwari Devi of Pratapgarh versus CIT 147 ITR 258. Similarly, in the case of ACIT versus Meenakshi Khanna 2013 decision 143 ITD 744 Delhi 88. So any lump sum amount received for giving consent for divorce is not taxable. It is a capital. So always opt for lump sum amount. Definitely, it is a capital receipt. Even now under 56(2)(10, because the money is paid after granting the divorce. It is not from your spouse relative. He is no longer a relative. Husband is not a relative because he is a erstwhile husband. So she receives the money from an erstwhile husband, a non-relative, as on the date of receiving. Is it taxable under 56(2)(10)? In my view, the earlier decisions hold good even now, because for a consideration, she is giving her consent to give the divorce. it itself is a good consideration. So whatever she receives still is a capital receipt, not taxable. I'll go to 8th area, which was majority of the times we have been not properly planning. So 5 days back, the amendment of section old 45.4 is now being proposed to be replaced by the finance bill 45.4. What is 45.4? A mirror image of 45.3. What is 45.3? A partner bringing in any capital asset at the value that is recorded in the books of accounts, the partner has to pay the capital gains tax, because partner is different, firm is different. Partner is bringing in an asset at the value that is recorded in the books of accounts of the firm. The partner pays the capital. 45.3 opposite is 45.4. What is 45.4? Any firm AOPBY, if partner member of that entity is taking away, either at the time of dissolution or otherwise, some property, the market value of that is deemed to be the consideration, and the firm has to pay the capital gains tax. So now the partner, while he is retiring, the asset is revalued. Asset is not given to the partner, retiring partner. The assets are revalued. His due share credited to his capital account. The remaining partner paid the money to the retiring partner. So the partner's original investment may be a small money. Let us assume that 5 partners brought a piece of land for 5 crores. 5 partners bringing in 5 years back, each 1 crore, they bought a piece of land for 5 crores in Chennai city. And after 5 years now, it is worth 15 crores. So they revalued it as 15 crores. So this 5th partner who wants to go away, his account is credited with the 2 crores devaluation money, and he takes back. So till this year, it was not taxable in the hands of the partner. Firm pays no income tax, partner pays no income tax. They brought the amendment 45.4 saying that after revaluation, any money is received by the partner. Now they, in the 45.4, they used the word specified entity, specified person, and they said the firm has to pay for that money extra the capital gains tax, and it is a deemed transfer. So the 45.4 is now brought in for revaluation of assets, the extra money becoming a taxable income. The 45.4a also is another good thing. Whatever the partner receives more than his original capital is the capital gain, which is in the hands of the firm, is taxable. So the earlier, but keeping aside, because the firm pays over and above its capital is not taxable, decisions were there. One such decision is Tribhuvan Das G Patel versus CIT. Tribhuvan Das G Patel versus CIT, 236 ITR 515 Supreme Court decision. So partner receiving more than his capital is not taxable. This is the Supreme Court decision. Now it is overruled from this budget on. Now apart from this, what is taxable even earlier was unknowingly, the same example, 5 partners were there. 1 partner is retiring. A new partner is coming in the place of that 5th partner. A new 6th person is coming in the place of that 5th partner. Same day the retirement and joining. You write the partnership deed, reconstitution of the partnership deed in such a way that the 5th partner is retiring, the money due to him is being brought by the 6th one who is joining in his place. So the 5th partner share is being now allotted to the 6th partner who is coming in the place of the 5th partner. You drafted the reconstitution deed in such a way that as if the fifth partner is selling his right in the firm to the new partner. If that meaning is coming earlier or even now, the partner is liable, not the firm, because no asset of the firm is being transferred, no asset is revalued, firm is not paying any money to the partner. The incoming partner is paying the money to the outgoing partner. So the old decision 257 ITR 449, the 2002 Delhi decision is Vishamlal Kanodia. That means a partnership right is also a capital asset, right, and if it is being sold, not directly sold, because partnership is by agreement. So the agreement is drafted in such a way that his right is being transferred. It's a capital asset transfer. It is liable. So the retiring partner receiving more money than what is capital, if it is from an incoming partner specifically, then definitely it is taxed. So the partner's retirement, unless carefully drafted, when it becomes taxable, when it is not taxable, a thin difference will be there. Even without this amendment also, this year amendment also, one should be very careful in drafting such agreements and then taking care of the tax portion. Now I'll go to the ninth item. The ninth item is 99 lease. So any 99 lease normally of immovable property. So the 99 lease is equal to sale. That was so held even the Madras High Court in 2014, 265 CTR 545. This is K. Bhagyalakshmi versus DCIT. So the Madras High Court has held that 99 years lease, if you receive some lump sum amount, it is equal to sale. Come on, pay the capital. So it was so held. In another Mumbai decision also, it is liable for capital gains. ITO versus Sham P. Todiwala. So this was the decision. Now coming to the other side, when it is not taxable, in whose hands it is not taxable? Come to the other side. So that is a CET versus Madras Auto Services Private Limited, 233 ITR 460. So this case, what we have to examine, how the non-taxable portion, or say the otherwise the opposite of this 910 is. Here, the SSC has taken a land for lease for 39 years. In this case, CET versus Madras Auto Service. So the agreement is recital is saying that whatever you want to deal with the land, you deal. Whatever the buildings if you want to construct, you construct. But while going, terminating the lease deed, the buildings are to be left as it is, which will go to the lessor. So the lessee got 39 years lease and then started constructing the building. Now, is the building a capital asset? Only eligible as block asset depreciation, or is the building a revenue expenditure? So the matter went up to a court. The court held that when he has no ownership right for the building, land is belonging to somebody else. He has taken on a lease. So the building, the moment he constructed, the right to building is as per the terms of the lessor. The buildings you have to leave to me. You may enjoy the uses of the building, but the ownership of the building is with the lessor only, not to the lessee. So you are having only usage value. So the building cost totally is allowable as revenue expenditure in the first year itself. This is the decision 233 ITR. Even now it holds good in my view. So the enduring benefit, if you want to see, is it an enduring benefit? We don't know when the lease gets terminated, depending upon the business circumstances, exigencies. So the court held it is a revenue expenditure, allowable as revenue expenditure in the very first year itself. So in the long-term leases, what is to be drafted and how it's going to be affect the taxation point of view also, one can see in the light of these decisions. So then the 10th point I would like to take. The Income Tax Act, or for that matter any taxation statute, will contemplate not only the existing associates existing liability, after they cease to exist also, because of their transactions, their liability who will discharge. So any taxation law, the direct tax and indirect tax, we have some provisions which say that, for example, a few minutes back we have seen section 159. Section 159, what it says, in the case of a deceased tax liability, deceased never filed the return, but he sold the land. Now in 26 says it has been reflected. So deceased never filed the return, never was an assessee, but he sold for a huge amount. Now his legal heirs who are getting his estate then becomes legal representative. So the legal representative as defined in the Income Tax Act as per section 159, actually the legal representative word Income Tax Act imported or Income Tax Act refers to the Civil Procedure Code. So as defined in the Civil Procedure Code, the legal representative is liable under the Income Tax Act section 159 to discharge the liability of the deceased. So deceased estate, to the extent he inherited, his liability is restricted. So legal representative, if an individual dies, similarly if a partnership firm is succeeded by another partnership firm, section 188. So the succeeding partnership firm has to discharge the earlier partnership firm. Even if the partnership firm is dissolved, the S2L partners, 189, the next section. S2L partners have to discharge the liability of the partnership firm. Similarly, executors, on behalf of deceased, if executors are earning the income distributing to the legatees or say successors, so the executor are also liable. So even if a company is being liquidated, section 178, the erstwhile directors have to discharge the liability of the company. So in all circumstances like individual, partnership firm, even a discontinued business 1764, everything is taken care of. In respect of HAF, there is a possibility, not a possibility, an existing situation is. HAF, section 171, partial partition is not to be accepted. Total partition is only to be recognized by the Income Tax Department. In case of a HAF hitherto assessed, reading together 170, 171, the HAF hitherto assessed HAF, even after partition, the co-partners who shared the HAF property are liable for the old HAF tax liability. Now the situation, if a HAF was not assessed earlier, a HAF is holding some land, for example, 4 brothers are co-partners in HAF. In the outskirts of Chennai city, they are having 4 acres land. The 4 acres land they sold for 4 crores. They registered the document. Next day in the bank, whatever they received, the 4 crores, they from the joint account, they transferred the money to individual accounts. On that day itself, HAF partition is over. HAF was never assessed. HAF is no longer existing. They shared the money. Can such HAF be assessed by giving a notice? Income escaped. Can a section 148 notice can be given? No is the answer. In fact, this lacuna was brought before the Law Commission also. Some 10 years back, the Law Commission said, we don't want to amend the Income Tax Act. So this HAF, which was not assessed earlier, even if income escape is there, a clear tax liability was there, An assessing officer having jurisdiction over the HAF cannot issue Section 148 notice for income escape. So, number of decisions. The additional CIT versus Durgamma 166 ITR 776 AP decision. CIT versus Kantilal Ambalal 192 ITR 376 Gujarat 192 ITR 376 Gujarat decision is there. And another decision, the Karnataka, that is a 140 ITR 434. So these are all the things what they say, whether Gujarat, AP, Karnataka. So in a HUF, the wording in the Income Tax Act is more important. What is the wording in the Income Tax Act more important? A HUF which is hitherto assessed as HUF, even after HUF total partition, the erstwhile O-partners are liable for the HUF tax liability. So a HUF which is not assessed at all, if it disappears, that means after the existence, ceasing to exist, cessation of existence, after ceasing to exist, can the department open its eyes and then tax it? The answer is no. So the Income Tax Act and GST Act, actually February 1st GST Act at par with 281B, the Income Tax Act provisional attachment. The GST Act, what they have found as a lapse, they brought on February 1st under GST Act. When the proceeding, any proceedings initiated under the GST Act, at the time itself provisional attachment can be made for any property of the person who is likely to have the GST liability. A provisional attachment is brought in. So like that, the liability of a non-existing person still can be fixed, still can be assessed, still tax due can be arrived, and still can be recovered, except in the case of HUF, which was not existing, which was not assessed hitherto earlier, cannot be taxed now. So that is the 10th instance I have taken as an exceptional transactions under the Income Tax Act. So when it is taxable, when it is not taxable, a thin difference is there. Now, I will go to the 11th item. The 11th item is compensation for relinquishment of right to sue. Normally, right to sue emanates under different acts. There are civil rights under the Civil Procedure Code. If it is a criminal offense, to sue under the Criminal Procedure Code. So the right to sue, if you are going to surrender, for example, under Negotiation Act 138 say to right to sue for a dishonoring check, you will file a criminal complaint. So ultimately he pays some money. So if though the act says check amount only you pay, you will get some money extra is also paid. So now the right to sue, if it is given, then the money received of this nature is not taxable. A right to sue is surrendered. For example, the defamation. Somebody made some acts to defame somebody. So the person who is defamed will file a suit, a defamation suit. So ultimately, defamed should both of them compromise. They receive some money. Is that money taxable is the question. So like that, the right to sue if it is surrendered. So there is a case, Popular Estate Management Limited versus DCIT, because the 56-210 background, you are compromising. The compromise not to do a particular, I am giving my right not to sue you, not to do an act also is a consideration. So even now under 56(2)(10), this is not a money received without consideration. So suing itself is a right. That to file a suit, my right I am surrendering, receiving some money. So this is 78 ITR, Tribunal Decisions 261, Ahmedabad Decision, Popular Estate Management Limited. So here they said the money received of this nature is not taxable. In fact, there is an authority for advance ruling also, 381 ITR number 1. The authority for advance ruling decision, 381 ITR 1, the qualified settlement fund. There also they said if a right to sue. In fact, in earlier some of the instance also I have told you that the employee getting a compensation amount from employer as part of court settlement, or a person who purchased a property in the court auction. Then instead of going for registration of the purchase deed through court, somebody else, the real owner itself, has come to the court and said, no sir, please, though it is auctioned, I will pay that money. So please stop the auction. I am paying you extra also, something more he received. So then the right to purchase is surrendered, that extra is not taxable. So like that, the compensation for relinquishment of a right to sue is not taxable. So this is a valid point where even now under even after 56(2)(10), still it is a capital receipt, not a taxable, because there is no mechanism, there is no cost of acquisition or say capital asset being transferred. So those words will not fit in when the mechanism is not there. So though it's a money received, it's not a taxable. Now I will take you to another thing which I have already touched. For example, any current liability, a reduction in the current liability, what naturally will do, will transfer to the P&L account. That is nothing but the 41(1). Any expenditure earlier claimed, now reduction of that liability is an income taxable under section 41. Normally, whatever the liabilities we create as current liabilities, maybe for example purchases. Earlier I gave you unsecured loans capital portion reduction is a capital receipt. Purchases liability is sundry creditor. Sundry creditor liability is reduced, is taxable income under 41(1), because sundry creditor has come from the debit side of the P&L account. You claimed purchases, the sundry creditor's reduction in liability is a taxable income. So this is a normal. Go to the other side when it is not taxable. I am giving you few instances where the courts held it is not taxable. For example, before the GST, under the VAT Act, under the earlier State Sales Tax Act, several states have announced deferred tax liability. What is the deferred tax liability? First 7 years, whatever you collect as sales tax, first 7 years, whatever you collect, I'm giving an example. First 7 years, what you collect as sales tax, you keep the money with you. You pay in 8th year the first year tax. You pay 9th year the second year sales tax. That means 7 years interest-free sales tax cost. A deferred sales tax liability. So, like that, several states, several sales tax schemes they have announced. Now, when the GST comes, instead of continuing the same act, same thing, a particular state, let us say, has given your future payment. Now you are in the 6th year. You are having 5 more years to pay different amounts in the coming 5 years. I am offering you now at a particular rate you discount. you pay the net present value of that future liability. Your current liability, deferred sales tax liability, will come down to 50%, let us say, because after third year, fourth year, fifth year, what you have to pay now means with a rate, particular rate you have discounted, net present value has come down. So the liability will come down. The remaining amount, is it a revenue receipt or a capital receipt? So the Bombay High Court in Principal CET versus MRP Limited, 73/2020 decision, 2020 March 17, just exactly less than a year ago decision, Bombay High Court has said this is a capital receipt, a liability, not a current asset liability reduction. It is a capital receipt, not taxable. So a very thin difference between ordinary sales tax liability being reduced. For example, a sales tax in appeal. You paid the money and we have gone into appeal. In the appeal, we have won the sales tax. Then automatically the sales tax department gives the refund. With that refund, we reduce our sales tax. Say we have to take the, because already paid sales tax if you have debited to the P&L account. Now the sales tax refund we have to credit to the P&L account. So here the sales tax already you have collected, not paid to the government, but payment has come down. But it is not a refund from sales tax, but because the capital value, the future liability you have reduced, very thin difference. The court held it is a capital receipt, not taxable. So principal CET is MRP Limited, the 2020 March decision. Similarly, the 2018 earlier decision, CET versus Balakrishna Industries Limited, 300 CTR 209 Supreme Court decision. Similarly, CET versus Balakrishna Industries Limited, 300 CTR 209. The Supreme Court decision of 2018 said it is not taxable. It is a capital receipt, though it relates to current asset transaction, current liability transaction. In similar case, in 2016, the Gujarat High Court, 386 ITR 626. Please see this. Entertainment tax collected by the government. The Gujarat High Court collected the entertainment tax. It gave back as a subsidy. So the subsidy is in the part of the amount of entertainment tax collected. Entertainment tax collected by the government means you would have debited the entertainment tax as expenditure. That is given as a lump sum amount. So the basis is what you paid, we are giving back to you to promote the industry. DCAT versus Inox Leisure Limited. Inox Leisure Limited. So the court, Gujarat High Court, held in 386 ITR that is a capital receipt, not taxable, though it is named as a subsidy. But of course, subsidies, as we have already seen, after the ICDS, subsidies for depreciable assets will reduce the cost. Section 43(1), explanation 1090. So the 43(1) cost of the asset, depreciable asset, subsidy shall reduce because cost, part of the cost is met directly or indirectly. But here, not for the particular asset. Simply I am giving you the capital subsidy because you have paid the entertainment tax. I want to encourage the industry, not for cost of the asset. So it is a capital receipt, not taxable, the court held. Now I am going to my last item for today, that is the exceptional transaction, when it is taxable, when it is not taxable. For example, in the seller's hands, so for example, a purchase of machinery, an agreement between two persons. One manufacturer of machinery has entered into to a particular entrepreneur to sell the machinery. So the seller's hands, for example, he receives some advance, and that advance, for example, if it is forfeited, naturally it's a business income, it is a taxable. It is taxable. So, for example, after purchasing the machinery, the seller, you are owing some money to the seller. So naturally we pay 80%, 90%, 10% we withhold, saying that we will see 6 months performance, then we will pay you the remaining 10%, 5% or 20%. Now that 10%, 20%, if the seller waives, what will happen? You purchase the machinery, liability is still existing some part. That liability is waived by the seller. You need not pay me because you paid promptly, and because of you purchasing, I got more customers. You popularized my name, so I am waiving. So then, what they waive is a capital receipt will reduce the cost of the machinery, because the cost of the machinery is met directly or indirectly with somebody. The seller himself has reduced the cost even subsequently. So definitely it shall reduce the cost of the machinery. That was so held by Delhi High Court also, 348 ATR 150, that is Steel Authority of India Limited. So reduce the cost of the machinery. We will see the opposite. It will not go to reduce the cost of the machinery. When? Second difference. See, the seller has given you a performance guarantee. Say per hour or per day of 8 hours, it will produce say 20 tons. Even after 1 year use, 2 years use, it has not produced 20 tons per hour. Its capacity has come down. Its real performance is not up to mark. However, efficiently they run the machinery. The seller himself has come with the technical people, let us say, has tried to repair it, reinstall it, and then do whatever he wants, he has done. But in spite of all these things, the performance is not up to the mark. The guaranteed performance is not there. Machinery performance failure is there. So if the machinery performance failure is there, then that 10%, that money, the buyer says, I am forfeiting, I am not going to pay you, because it is there in the original agreement that if the performance is not up to mark, the retention money will not be going to pay you. So now, is that money, shall that reduce the cost of the machinery or not is the question. You need not reduce the cost of the machinery. It is a capital receipt because you have suffered something. So what you are suffering for your loss, that clause you have preserved. So what you receive is not taxable. It is a capital receipt. DCIT versus Expro India Limited, 161 ITD 93, the Karnataka ICAI edition of 2016. They say, though it is related to the machinery, it is not related to the cost of the machinery. It is related to the performance of the machinery. As the performance has failed, it is a capital receipt. So not to go to reduce the cost of the machinery. So the very thin difference when it, because the cost of machinery reducing is depreciation, you will lose. A capital receipt means no question of losing the depreciation. Still on the original cost, you are entitled to get the. So the thin difference is there. Actually, I told you earlier that ICD is 7 with the 43(1) definition of the cost of the asset. Explanation 10. So the government grant subsidies. So all these things what I say. So there will be a thin difference in the wordings, in the transactions. So we cannot equate one with the other. They may apparently go to say only in both the places the seller is receiving the lesser money or seller is going to forego the money. But in which situation, how to treat it? I have given some of my thoughts in the limited time available. I try to present. These are all the exceptional transactions I have named it. So a thin difference will be there when it is a salary, when it is not a salary, when it is an interest taxable under the head of the, when it is not taxable, when it is a business income, reduction of a liability, and when it is a capital receipt, not a business income. So like that, when it is the cost of the asset, when it is not part of the cost of the asset. So like this, a number of situations I have taken based on the decisions I have gone through. So even after this thing, actually, if you talk about the procedural things, many number of times it so happens under the Income Tax Act, it is not the obligation of the legal heir to inform the death of the deceased. Under the Income Tax Act, it is not the obligation of the legal heir to inform the assessing officer that so and so died. Then based on the computer data, based on the 26 years, the assessing officer, seeing his bank account transactions, he will issue a notice to a deceased person. The notice issued to a deceased person, these people receive the notice, simply keep quiet. Let us say, he issued within the due date that notice. After that also time is over. Yes, I have given you 148 notice. Come on, why you are not come? Somebody inquired and ultimately they have come to know through the same bank account, they went to approach the banker. Oh, where is his address, residential address, is it currently transacting? Then banker would have told them, sir, that person died 1 year back. So now the 292B or 292BB, will it come to the help of the disease officer to say that any defect in the notice, any defect in the service of the notice is get absolved and it shall be taken as a proper notice? Can it be there? No. On a deceased person, serving a notice is 100% invalid. Whatever the assessment subsequently done, either 143.3 or 143.4 ex parte assessment, nothing is valid. Everything is invalid. On a deceased person, they cannot. What the officer should have done? The officer should have served within the time a 148 notice on the proper legal representatives, not on the proper legal heirs. By chance, he serves a notice on the legal heir also. That particular legal heir may say, though he was my father, he has not given me anything. To my elder brother only, he has given all the property. So I am a legal heir, my elder brother is a legal representative. You please serve the notice on the legal representative. He will discharge my deceased father's liability. So then serving the proper notice on the proper person is so important, and the deceased person serving a notice of no use. Department cannot collect 1 rupee. So the thin difference will be there under the Income Tax Act. When the tax liability will not be there, we can think of several situations like this. So, for example, the 148 notice, 148 section itself is replaced on the recent 2021 finance bill proposal. So 148A, so many defects are cured. So I am thankful to the SIRC for giving me this opportunity of presenting some of my thoughts in exceptional transactions where something is taxable, where it is not taxable. So I have given you the live examples as I understood from the case laws. So it is up to the organizers in the last few minutes.
Thank you, sir. Thank you, sir. And I'll just try to. I have got not a question. I'll just try to post the questions here. So 1 minute. I'll just take it. I'll just flash my screen, sir. Just let me know whether this question is visible. This is one question which popped up, and if there is any, we'll be posting the same to you through mail, sir. This one question.
Yes, please, sir. This is with regard to unregistered temple trust, slightly out of it, don't worry. Application of corpus fund towards construction of temple property, whether exempt from tax. Up to 17, 18 here, not taxable. It is exempt only. It is not exempt, say it is not taxable up to 17, 18 assessment year. From 18, 19 assessment year, under 56 to 10, the corpus fund donation, because 56 to 10, any person, unregistered temple, receiving from other persons any money without consideration is taxable. So this is from 2018-19 assessment year is taxable. Earlier years up to 2017-18 not taxable. So this with relation to a public trust, I think. So even then, with the little knowledge I have answered this. This is the question. This is the answer. Yes, please.
Thank you, sir. And those are the one question that popped up, and we'll be getting the queries through mail, sir, once we give the feedback form. And once we receive, we'll just send the mail to you, the request questions to the mail, sir. Sure. And we thank you on behalf of SIRC for taking us to 2.5 hour session with the knowledge and teaching.
Okay,
And
okay. So if there are no more questions, we'll wind up.
there are no
Thank
more
you.
questions, and we do have received for past 3 days. We have received a lot of questions, and we have been forwarding to the speakers for the
Okay,
sessions, and we'll be
okay,
sending the speakers. Okay, and all
okay,
3 session recordings will be updated in our website and also in our YouTube channel for the future benefits of the members. And we
okay,
thank you
okay.
for your presence. Thank you, sir. Thank you very much. Thank you.